Hey everyone, today we are going to determine what price you should pay for Google stock. But before doing that, with the discounted cash flow model, let's take a look at the recent news of this company. As you can see, Google has sold off massively in the past days. It fell 7% in one day. So for a company as big as Google, this is a huge move. And this is because of this news. So essentially, Google presented its own AI. Google's event took place just one day after Microsoft hosted its own AI event, and the shares of Google fell during the event, meaning that investors were hoping for more and they think Microsoft is winning the artificial intelligence competition. In my opinion, this is an overreaction from the market, something that we don't have sufficient information yet, and something we should not take into account when evaluating Google stock yet. So now let's move on to determine what price you should pay for Google stock. We don't know the future, however, we can make assumptions about it to see what we should pay for a future stream of cash flow. I am going to make 7-year assumptions on Google stock to see what price I should pay for Google stock today. Starting with our revenue assumptions, here we have Google's revenue from their last earnings release. For the full year, they still grew revenue by 10%. They are growing revenue on top of the craziness that we saw in 2020 and 2021. Google is still managing to grow their top line, which is impressive. They also had a massive FX headwind in this quarter, so if you remove the FX headwind, they grew revenue 14% on a full year basis. Now let's zoom out a little bit. You can see that the revenue growth percentage is decreasing as time moves on. This is because as they get larger and larger, it is going to be more difficult for Google to grow. They are no longer going to grow at a 20% rate. As you can see on the screen, this year Google is expected to grow 5%, and next year Google is expected to grow 11%. So this is why on my low assumptions I went with 5%, on the middle with 7%, and on the high end with 10%. Moving on to the profit margin and free cash flow margin, we can see that they are very similar and very consistent over time. Over the last 10 years, their average was 22%. Over the last 5 years, 23%. And this year they had a profit margin and free cash flow of 23%. So I went for 21 on the low assumptions, 23 on the middle, and 26 on the high assumptions. I went high on this last assumption because they have said on their last conference call that they are going to increase their efficiency, which is going to increase their cash flow and profit margin. In terms of PE and price to free cash flow, the average of the stock market is around 15. You should pay a premium for Google because they have a high moat and one of the best balance sheets. This is why I went for 16, 18, and 19. Finally, the discount rate is the return you want to get each year on your investment. When you invest in an ETF, you can get 9%. So if you take the risk of investing in an individual stock, you should have a higher return. And as your assumptions get higher, your rate of return should be higher. This is why I went for 10%, 12%, and 15%. The stock is currently trading at $94 a share. Therefore, if you believe the high assumptions, this stock is currently a buy. If you believe the middle assumptions, you have to wait a little bit. It's basically there. And if you believe the low assumptions, the stock still has to fall a little bit. In my opinion, Google stock is a great buy. However, because I believe stocks are going to go lower, I'm going to be more conservative and I'm going to wait till it hits the low assumptions. Thanks for watching, and I'll see you on the next one.